Hello everyone, you're very welcome back to the channel. Today we're talking about how bankruptcy works in Ireland. But we're not just talking about bankruptcy. You see, bankruptcy is the last resort option for individuals who can't pay their debts. Bankruptcy is a judicial debt resolution process, meaning that financial settlements and arrangements are made within the Irish court system, specifically the High Court. In order to save on High Court time and resources, the Personal Insolvency Act was introduced, and with it came 3 non-judicial debt resolution processes. Idea being that if settlements and arrangements can be made with an individual's creditors outside of the court system, then that should be the first and foremost priority. So the goal of this video is for you to understand what these non-judicial debt resolution processes are in addition to bankruptcy, and for you to be aware of the support that is available for those who are struggling with debt repayments. All sections of this video will be timestamped for your convenience. Each of the 3 non-judicial debt resolution processes introduced under the Personal Insolvency Act can be described as insolvency arrangements. Therefore, in order to avail of these arrangements, one must be considered to be insolvent. An individual will be insolvent if A, they can't repay their debts when they fall due, B, their assets are worth less than their liabilities, and C, they have no realistic prospect of being able to repay their debts in the foreseeable future. All 3 of those conditions must apply for an individual to be considered insolvent. Conversely, if at a point in time an individual is unable to repay their debts due to a lack of cash, but their assets are worth more than their liabilities, then they're not considered to be insolvent. That's because their debts could be repaid if the assets were sold or if the debt itself was to be restructured. In this circumstance, the individual would be considered as illiquid rather than insolvent, as they have a liquidity problem, not genuine insolvency. Where genuine insolvency does exist, the 3 non-judicial debt resolution processes under the Personal Insolvency Act will become available. The first of which is a debt relief notice, or DRN. A DRN is available for individuals who have less than 35 grand worth of debt. This debt can be secured or unsecured debt, but typically a DRN is used for the purposes of dealing with unsecured debt, i.e. credit card debt and personal loans. The appeal of a DRN is that at the end of the process, which is 3 years in duration, the individual will be debt-free. In other words, at the end of the 3 years, your DRN debts will be written off and you won't owe any more money. As is the case with each of the 3 non-judicial debt resolution processes, an individual may only have 1 DRN in their lifetime. To qualify for a DRN, a number of conditions must be met, the most significant of which are as follows. You must be insolvent with no realistic prospects of repaying your debt within 3 years. You must have a net monthly disposable income of €60 or less after reasonable living expenses have been accounted for, and you must have assets worth €1,500 or less. For the purposes of the assets test, allowances are made for jewellery, motor vehicles, and necessary household equipment. Net monthly disposable income is calculated as net income after tax minus reasonable living expenses. For the purposes of calculating reasonable living expenses, factors that are taken into account include your marital status, your children, whether you drive, the yearly cost of your car insurance, the cost of your monthly rental payment, and the monthly cost of childcare. This approach ensures that every individual is afforded a reasonable standard of living irrespective of their liabilities. If after accounting for reasonable living expenses each month you have €60 or less to your name, then you will be eligible for a DRN. If you are successful in securing a DRN, then you will enter what's known as a 3-year supervision period. During this period, you have no obligation to make any debt payments, and your creditors can't contact you asking for the debts to be repaid. This is all predicated on there being no material change in your financial circumstances. If there isn't, then at the end of the 3-year period, your debts will be written off. However, if your net income per month increases by more than €400 during this period, then you'll be required to sacrifice 50% of the increase for payment to your creditors. Likewise, if you receive any gifts worth more than €500, 50% must be surrendered. During the supervisory period, you are obligated to inform any prospective lender of your insolvency status when taking on any more than €650 worth of new credit. credit. If at any time during the 3-year period you repay 50% of your debt, then the debt will be deemed to have been paid in full and the DRN will cease. It's important to be aware that a DRN is not available to individuals who have availed of any of the other formal debt resolution processes within the past 5 years. The second non-judicial debt resolution process is a debt settlement arrangement, or DSA. A DSA is available to individuals who either have unsecured debts in excess of 35 grand, thus making them ineligible for a DRN, or to individuals who have unsecured debts less than 35 grand but fail to meet the other conditions for a DRN. DSAs only apply to unsecured debt. Similar to a DRN, in order to qualify for a DSA, a number of conditions must be met. The most significant of which are as follows. You must be insolvent with no realistic prospects of repaying your debt within 5 years. You must not have incurred more than 25% of your debt within the past 6 months. You must not have been subject to a DRN within the past 3 years, and you mustn't have availed of any of the other formal debt resolution processes within the past 5 years. DSAs can be 5 or 6 years in duration. The purpose of a DSA is twofold. Firstly, it allows the individual to negotiate an affordable amount that he or she will repay to his or her creditors over the repayment period. At the end of this period, similar to a DRN, the individual's unsecured debts will be written off. Secondly, it grants the individual protection from his or her creditors through the issuance of a protective certificate. This certificate lasts for 70 days and it grants the individual time to negotiate with his or her creditors without fear of legal proceedings. Crucially, in order for a DSA to come into effect, at least 65% of the individual's creditors in terms of debt value must agree to the terms of the DSA. If the individual can't secure this consensus, then no DSA will be available. Where a DSA is agreed upon, the individual's creditors can no longer take action to enforce the debt for the lifetime of the DSA. If the individual subsequently falls into 3 months worth of arrears under the new repayment terms, the creditors can apply to the courts for a DSA termination. This will happen automatically after 6 months worth of arrears. The final non-judicial debt resolution process is a Personal Insolvency Arrangement, or PIA. For anyone who has a mortgage, a PIA is going to be your only non-judicial option. Reason being, because you own a property, you're going to fail the asset test for a DRN. Furthermore, because you're insolvent, you'll need to negotiate the repayment terms of both your secured and unsecured debt. Therefore, a DSA, which only applies to unsecured debt, won't be available. As before, in order to qualify for a PIA, a number of conditions must be met. The conditions are largely the same as the conditions for a DSA. The biggest difference being the requirement to have secured debts in addition to unsecured debts. Additionally, you must have cooperated with your lender under a mortgage arrears process for a period of 6 months, and you mustn't have agreed to an alternative repayment arrangement, or ARA, as part of that process. ARAs can take the form of payment moratoriums, loan term extensions, and interest-only repayment periods, among other options. PIAs can be 6 or 7 years in duration. The goal of a PIA is to A, write off some of your unsecured debt, and B, restructure your remaining secured debt. Most importantly, the PIA will be drawn up in such a way that ensures, insofar as possible, that the individual will not need to sell or move out of his or her home in order to settle his or her debt. Again, the individual will seek to negotiate an affordable amount that he or she will repay to his or her creditors over the repayment period. At the end of this period, the individual's unsecured debt will be written off. As for the secured debt, restructuring will take place. This might include an extension of the mortgage term, debt write-off, and/or interest-only payment periods. The end goal being a more feasible monthly mortgage repayment based on the individual's net monthly disposable income after reasonable living expenses have been accounted for. In order for a PIA to take effect, 65% of the individual's creditors in terms of debt value must agree to the terms of the PIA. Furthermore, over 50% of the individual's secured and unsecured creditors must vote in favor of the PIA. If the individual can't secure this consensus, then he or she can make an application to the court under Section 115A of the Personal Insolvency Amendment Act of 2015 to effectively overrule the creditor's decision decision and enforce the PIA. Although not guaranteed, this provision shifts the balance of power in favour of the individual and partly explains why Ireland has one of the worst outcomes in Europe in terms of the recovery of security for mortgages under judicial processes. In the absence of a PIA, an individual will enter bankruptcy, where it is possible that his or her home will be lost. Again, where a PIA is agreed upon or enforced, the individual's creditors can no longer take action to enforce the debt for the lifetime of the PIA. If the individual subsequently falls into 3 months worth of arrears under the new repayment terms, the creditors can apply to the courts for a PIA termination. This will happen automatically after 6 months worth of arrears. Only where attempts at securing a DRN, DSA or PIA have failed does bankruptcy become an option. In order to be eligible for bankruptcy, an individual must have debts exceeding €20,000. When an individual is made bankrupt, his or her assets are transferred to what's known as an official assignee, whose responsibility is to sell your assets and distribute the proceeds of sale to your unsecured creditors. All of your assets are transferred to the official assignee, with the exception of essential assets up to the value of £6,000 and one current account where up to €1,000 can be kept. The official assignee will determine your net monthly disposable income after reasonable living expenses have been accounted for. If this figure is positive, then you'll be required to pay that sum of money as a contribution towards your debt for a period of 36 months. These payments, in addition to asset sales proceeds, will be used first against fees associated with the bankruptcy proceedings and second against your unsecured debts pari passu. After these payments have been made, unsecured debts are written off. What happens to your secured debt, and thus your home, depends on two factors. A, whether your home is considered to be a family home, and B, the value of your home relative to the loan outstanding. If your home is considered to be a family home, which per the Family Home Protection Act of 1976 is a dwelling in which a married couple ordinarily reside, then the official assignee cannot sell the home without first obtaining permission from the High Court. If your home isn't considered to be a family home, i.e. if you're single or cohabitating, then the official assignee does not need to obtain such permission from the High Court. This places married couples in a much more favourable position than single individuals. When deciding whether or not the family home should be sold, the official assignee will look at the value of the home relative to the loan outstanding. Remember, the official assignee now owns the bankrupt individual's share of the property. If the home is in negative equity, i.e. the value of the loan outstanding exceeds the value of the property, then the official assignee will have no incentive to sell the home. This is best explained using an example. Let's say the value of the family home is €350,000 and the outstanding loan is $400,000. Furthermore, assume that unsecured debts amount to $20,000. If the family home is sold, the bank will collect €350,000 out of the $400,000 that it's owed. The remaining $50,000 would be reclassified as an unsecured debt, bringing the total balance of unsecured debts to €70,000. In other words, the net unsecured debt position will have worsened as a result of selling the property. Therefore, if it's possible to restructure the mortgage in such a way that the bankrupt individual can meet some form of monthly mortgage repayment while maintaining a reasonable standard of living, then that will be the preferred option. Remember, the individual's unsecured debts will be written off during bankruptcy, which in theory should increase the individual's capacity to meet mortgage repayments. However, restructuring isn't always viable, and handing back the keys to the bank may be the only option. If the home is in positive equity, i.e. the value of the property exceeds the value of the loan outstanding, then the official assignee will have incentive to sell the home. Let's say the value of the family home is $400,000 and the outstanding loan is €380,000. Assume that unsecured debts amount to €50,000. If the family home is sold, the bank will collect the full amount of money that is owed. Of the remaining excess of $20,000, seeing as the other spouse is entitled to half, the residual balance of $10,000 would be used against the unsecured debt, bringing the total balance of unsecured debts to be written off down to $40,000. Before making an application to the court to sell the property on the open market, the official assignee will first give the bankrupt individual and or his or her spouse the option to purchase the official assignee's equity interest of $10,000. If this interest is purchased successfully, then the couple would keep their home, provided that their monthly mortgage repayments are met going forward. If the interest isn't purchased, then an application will be made to the court to sell the property on the open market. This graphic summarizes the process nicely. With respect to the property being in negative equity, it's important to be aware that if the house isn't sold within 3 years of bankruptcy, then the official assignee's interest in the home will automatically pass back to the bankrupt individual. However, this is only a good thing if the individual can afford to meet the restructured monthly mortgage repayments. Also, if at any point within the 3-year period the property transitions from negative equity to positive equity, the official assignee will want their equity share to be bought out even if the mortgage has been restructured. That's because the official assignee is obliged to act in the best interests of the unsecured creditors. Things are more straightforward when the property isn't classified as a family home. If the property is in positive equity, then it will be sold outright, with 100% of the equity value being used to repay unsecured creditors. If the property is in negative equity, then the keys will likely be handed back to the bank if the individual can't afford to stay in their home even after unsecured debts have been written off. After 1 year of bankruptcy, a bankrupt individual will become what's known as a discharged bankrupt, where he or she is no longer legally required to repay the debts that were included in his or her bankruptcy. There's still an obligation to make income contributions where applicable for a period of 3 years. A discharged bankrupt's name will remain on the bankruptcy register for life, which is another reason why settling out of court is preferable. I'll conclude this video by highlighting 2 schemes that are actively supporting individuals who are in financial difficulty. The first of which is the Money Advice and Budgeting Service, or MABS. MABS is a free of charge and fully confidential service which is available to those who are either in debt or are in danger of getting into debt. If you feel like you need a debt resolution process, be it judicial or non-judicial, then it's definitely worthwhile going for a consultation with MABS. The second scheme is Awalia, which is offered under the MABS bundle of services. Awalia is targeted specifically at those who are in serious mortgage arrears and are at risk of losing their home due to arrears. Awalia will be applicable to those who need a PIA in order to resolve their debt situation and to avoid bankruptcy. I'll leave the links to both of these schemes in the video description. Let me know if you have any questions on anything that was covered in this video. If you did find this video to be useful, don't forget to subscribe to the channel for more Irish personal finance content. Thanks very much for watching, and I'll see you soon.